Stop what you are doing right now and give me your full attention, because what I'm about to tell you matters. Silver has just crossed $100 per ounce. If you are holding silver right now, congratulations. You saw something that most people could not. You understood what others dismissed. You were right and they were wrong. But listen very carefully, because this is not the end of the story. It is not even close. What you are witnessing right now is only the opening scene of a much larger movie. And the central character in that movie is Donald Trump. What I am about to lay out will fundamentally change how you see the silver market, how you interpret Trump's recent moves, and most importantly, how you think about your own financial future. By the time you reach the end of this, you will understand why $500 silver is not a fantasy, not hype, not wishful thinking. It is a mathematical outcome driven by forces already in motion. And it all comes back to a plan that is being executed quietly, one the mainstream media refuses to connect or even acknowledge. If you are ready to see what is really happening, let us step into the hidden economy. Before I reveal what that plan looks like, you need a bit of context. I promise this will be brief, but it is essential. Without this background, the significance of what is unfolding right now will be impossible to fully grasp. Here is a fact that most Americans have never been told. The United States government once held 3 billion ounces of silver. 3 billion. That number is real. It is documented. For more than a century, beginning in the 1800s, the United States stockpiled silver as if national survival depended on it, because in many ways it did. Silver was a strategic asset. It was vital for weapon systems, electronics, photography, medicine, and countless industrial and military applications. Leaders understood a simple truth. In times of war and crisis, the nations that control critical resources hold the advantage, and silver was one of the most important resources on Earth. By 1942, at the height of the Second World War, the United States was sitting on nearly 4 years of total global silver production, safely stored in vaults and ready to be deployed if needed. Then in the 1980s, everything changed. Two investors from Texas, the Hunt brothers, attempted to corner the silver market. They accumulated enormous amounts of silver and drove the price from around $6 per ounce to nearly $50. The government panicked. Rules were changed mid-game, and then a decision was made that many now view as one of the greatest financial mistakes in American history. The United States liquidated its entire strategic silver reserve. Week after week, year after year, the government sold silver into the market until nothing was left. By 2002, America had gone from 3 billion ounces to zero, and here is the irony. After the government finished selling, silver prices collapsed to around $4 an ounce. Then they began one of the most powerful bull runs in history, rising from $4 to over $100 today. That is more than a 20-fold increase. The lesson is straightforward and brutal. When governments sell strategic assets, prices are crushed. When governments buy, prices explode. That brings us to today, to Trump, and to the sequence of events that suggests history is about to repeat itself, but in reverse. Over the past few months, a series of moves has taken place that most people either missed or failed to connect. Each one matters on its own, but together they form a picture that is impossible to ignore. In November of 2025, the Trump administration quietly added silver to the United States critical minerals list. There was no major announcement, no headlines, no panel discussions on cable news. Most people brushed it off as meaningless. That reaction could not be more wrong. Critical minerals are not ordinary commodities. They are materials the government deems essential to national security, economic stability, and defense readiness. When something is added to that list, it opens the door to strategic stockpiling, federal investment, trade protections, and long-term planning. Silver was not added casually. It was added deliberately. Less than a month later, on December 8, 2025, G7 finance ministers held an emergency call focused on export controls for critical minerals. Ask yourself why the most powerful economies on Earth would suddenly feel the need to discuss restricting the flow of raw materials. The answer came quickly. On January 1, 2026, China enacted export controls on silver, officially limiting how much could leave the country. This is not normal behavior. Countries do not restrict exports of critical commodities unless they believe they are entering a period of conflict, scarcity, or strategic competition. China is the manufacturing engine of the world. It produces everything from smartphones to solar panels. When China decides to hoard silver, it is sending a signal. They are preparing for something big. China made the first move, and Trump has never been the kind of leader who allows an adversary to move first without responding decisively. Just 4 days later, on January 5, 2026, the United States Department of Defense announced a partnership with J.P. Morgan to build a $7.44 billion state-of-the-art smelting and mineral processing facility in Tennessee. $744 billion is not a trial balloon. It is not symbolic. It is a serious strategic investment, and notice who is involved. Not the Department of Commerce, not the Treasury, the Department of Defense. That alone tells you this is no longer just an economic issue. This is about resource security in an era of economic and financial warfare. Now the picture starts to come into focus. What if Trump is preparing to rebuild a United States strategic silver reserve? Look at the dots. Silver is designated a critical mineral. China restricts exports and begins hoarding. The United States responds with massive investment in domestic processing capacity. Trump has repeatedly shown interest in resource-rich regions like Mexico, Canada, Greenland, and Venezuela. All of these areas share one thing in common: enormous mineral wealth. When you view these actions through the lens of strategic resource competition, the logic becomes unavoidable. Trump is positioning the United States to secure silver at scale. And if that happens, the silver market as we know it breaks completely. To understand why, you need to look at current inventories. The COMEX, the primary American commodities exchange, holds roughly 422 million ounces of silver. The London Bullion Market Association holds about 790 million ounces. Chinese exchanges together hold around 35 million ounces. And that number has been dropping rapidly. Add everything together and you arrive at approximately 1.22 to 1.3 billion ounces of registered silver across all major vault systems worldwide. That may sound like a lot until you remember history. The old United States Strategic Silver Reserve alone once held 3 billion ounces, more than double the amount that exists today in all the world's major vaults combined. If Trump wanted to rebuild even a modest reserve of 1 billion ounces, he would need to absorb nearly every available ounce on the planet. And Trump has never been known for doing things halfway. How could the United States even attempt this? Buying on the open market would instantly send prices soaring as traders front to run government purchases. Nationalizing domestic production would take decades, as U.S. mines produce only about 35 million ounces per year. That leaves foreign supply, particularly Mexico, the world's largest silver producer, along with Canada and other resource-rich regions. Seen through this lens, Trump's foreign policy posture stops looking random and starts looking strategic. Now consider the supply and demand fundamentals already in place. The silver market has been running a structural deficit for 5 consecutive years. Global demand has exceeded supply year after year. In 2024 alone, the deficit reached 17%, an enormous imbalance for a globally traded commodity. Demand continues to surge from solar energy, electric vehicles, electronics, medical equipment, 5G infrastructure, and artificial intelligence. At the same time, supply is constrained. Most silver is produced as a byproduct of other mining operations, meaning higher prices do not quickly translate into higher output. Inventories are draining. Vaults are being depleted. Lease rates have spiked, signaling stress in the physical market. China is hoarding. Shorts remain heavily positioned. And into this already volatile setup enters the possibility of the United States government itself becoming a massive buyer. That is the Trump factor. Any announcement of stockpiling, export controls, or trade restrictions could send silver sharply higher in a matter of days. Under these conditions, $500 silver is not extreme. It is a logical extension of forces already in motion. There are risks, of course. Governments can intervene. Recessions can cause temporary sell-offs. New supply could emerge over time, but none of these change the core math in the short to medium term. Silver has already crossed $100. Many people believe that means they are too late. History suggests the opposite. Adjusted for inflation, silver's 1980 high would be over $150 today. Gold has already far surpassed its own historical peak. Silver has not. This brings us back to you and to what this moment represents. Silver has been money for thousands of years. Long before paper currencies, long before central banks, civilizations trusted silver to store value and preserve wealth. That understanding never disappeared. It was simply forgotten. Now, as debt explodes, deficits compound, and confidence in fiat systems erode us, reality is reasserting itself. Trump sees it, China sees it, smart money sees it, and now so do you. Silver crossing $100 is not the climax of this story. It is the signal that the real movement is just beginning and that the next phase is about to unfold right in front of us. Whether we choose to acknowledge it or not, the real question is not whether this shift is happening, but whether you will position yourself ahead of it or look back later, wishing you had acted when the signals were this clear. History has a way of rewarding those who move early and punishing those who wait for perfect certainty. Silver crossing $100 has convinced many people that the opportunity is gone, that the move is finished, that the easy money has already been made. That belief is exactly what keeps most people on the sidelines, while the biggest gains are still ahead. Perspective matters. In 1980, silver reached just under $50 per ounce. Adjusted for inflation, that price would be well over $150 today. Silver has only just crossed 100. Even without considering the extraordinary conditions we are facing now, silver has not yet reclaimed its real historical high. Gold, by contrast, has already surged far beyond its 1980 peak. Gold topped out at $875 back then. Today, it trades several multiples above that level. If silver were simply to mirror gold's performance relative to its own peak, prices well above $200 would be entirely justified. And that comparison ignores everything unique about the current environment. Today, we are dealing with factors that did not exist decades ago. We are in the middle of a global energy transition that relies heavily on silver. Solar installations continue to expand at record rates, and every panel requires silver. Electric vehicles are replacing traditional combustion engines, and each one contains significantly more silver than a conventional car. The digital world runs on electronics, and electronics run on silver. Data centers powering artificial intelligence consume massive amounts of hardware, all of which depend on silver for conductivity and reliability. At the same time, medical applications continue to grow because silver's antibacterial properties are irreplaceable. Demand is not just strong, it is accelerating. On the supply side, the situation is rigid. Unlike gold, silver is rarely mined on its own. Roughly 70% of global silver production comes as a byproduct of mining copper, lead, and zinc. That means silver output cannot simply be ramped up in response to higher prices. Miners cannot flip a switch and produce more silver unless it makes economic sense to mine more of those other metals. New mines take years to develop, often a decade or more from discovery to meaningful production. Recycling helps, but it cannot close a persistent double-digit supply deficit. For the foreseeable future, supply is effectively capped. This is why inventories matter so much. The silver that already exists above ground is steadily being consumed. Vaults that once seemed well-stocked are now showing visible drawdowns. Emergency shipments across oceans have been required to relieve pressure in key markets. Lease rates, which measure the cost of borrowing physical silver, have spiked during periods of stress, signaling how tight the market has become beneath the surface. Headline inventory numbers can be misleading because much of that silver is not truly available for sale. The free float, the metal that can actually change hands, is far smaller than most people realize. Then there is China. When China hoards a commodity, prices tend to rise. This pattern has repeated throughout modern history. China spent years accumulating gold quietly, and gold responded accordingly. Now China is applying the same strategy to silver. Export controls are not symbolic. They are defensive measures designed to ensure domestic supply during periods of uncertainty. China is preparing for a future in which access to strategic materials may determine economic and technological dominance. They are not doing this accidentally. Layer on top of all of this the structure of the financial market itself. For years, silver has been heavily shorted through paper contracts and derivatives. Large institutions have sold silver they do not physically possess, betting that prices would remain suppressed or decline. This strategy works until it does not. When prices rise rapidly and physical metal becomes scarce, those short positions turn into liabilities. At some point, they must be covered. Covering shorts requires buying silver, often at higher and higher prices, which pushes prices up further and forces even more shorts to cover. This feedback loop is what creates explosive moves. We saw a glimpse of this dynamic when silver surged through key levels and borrowing costs spiked. That was only a preview. All of these forces were already in place before Trump made his recent moves. Supply deficits, accelerating demand, declining inventories, China's accumulation, and the structural vulnerability created by large short positions were already tightening the spring. What Trump introduces is a wild card with enormous implications. The possibility of the United States government becoming a strategic buyer of silver changes the equation entirely. A single announcement confirming plans to rebuild a strategic reserve could reprick silver overnight. Export controls, tariffs, or trade restrictions aimed at securing domestic supply could have similar effects. Each policy action would amplify pressure in an already stressed market. Under these conditions, $500 silver stops sounding extreme. In fact, it may turn out to be conservative if multiple factors converge at once. Markets do not move in straight lines, and there will be volatility along the way. Pullbacks will happen. Fear will resurface during broader economic downturns, but volatility does not negate direction. In 2008, silver collapsed during the initial phase of the financial crisis, only to surge from $8 to nearly $50 within 3 years. Today's fundamentals are far stronger than they were then. The demand base is broader, the supply constraints are tighter, the geopolitical backdrop is more unstable, and the monetary environment is far more extreme. That brings us to risk, because ignoring risk is how people get hurt. Governments can intervene. They have done it before. In 1980, rule changes crushed the silver market after prices surged. Could something similar happen again? It is possible, but the context today is very different. Back then, authorities framed the situation as reckless speculation by private actors. Today, the issue is a genuine supply crisis, compounded by strategic competition with China. Suppressing silver prices, while simultaneously needing silver for defense, infrastructure, and manufacturing, would mean working directly against national interests. That makes blunt intervention far less attractive. A severe recession is another risk. In a broad market panic, silver could fall alongside other assets in the short term. But history suggests that such declines tend to be temporary. Once the dust settles, hard assets often rebound strongly as monetary stimulus and deficit spending accelerate. Any recession-driven sell-off would likely represent opportunity rather than invalidation of the long-term thesis. New supply discoveries or technological breakthroughs are also possible, but they operate on long timelines. They do not resolve immediate shortages. So what does all of this mean in practical terms? It means that silver crossing $100 is not a signal to disengage, but a signal that the thesis is playing out. Many of the people who dismiss silver at $20, $30, or $50 are now realizing they misjudged the situation. Some will continue to wait, hoping for a perfect entry that never comes. Others will recognize that major structural shifts rarely announce themselves politely. The smart money understands this. They are not relying on paper claims or abstract promises. They are focused on physical silver metal that exists outside the financial system and does not depend on counterparties. They are also paying attention to companies that actually produce silver because mining equities can provide leveraged exposure when prices rise. They are staying informed, tracking policy signals, monitoring inventory data, and watching geopolitical developments closely. In a fast-moving environment, information becomes a form of protection. Ultimately, this moment is about more than price targets. It is about the role silver plays in a world where confidence in paper systems is eroding. For thousands of years, silver functioned as real money. Many languages still reflect this history, using the same word for silver and money. That was not coincidence. It was recognition of silver's ability to preserve value across generations. Fiat currencies, by contrast, rely entirely on trust, and trust can be lost far more quickly than it is built. We are living in an era of unprecedented debt, relentless money creation, and chronic deficits. Numbers that once would have seemed impossible are now treated as routine. This trajectory cannot continue indefinitely. At some point, reality asserts itself. When that happens, assets with intrinsic value tend to reassert their role. Trump's actions suggest he understands this dynamic. China's actions confirm it. Those who are paying attention can see the pattern forming. Silver crossing $100 is not the conclusion of this story. It is the signal that the next chapter has begun. The pieces are aligning. The pressure is building. The outcome will reward preparation and punish complacency. The only remaining variable is individual choice. Whether you act on what you see or dismiss it as noise will shape how you look back on this moment years from now. The hidden economy is no longer hidden. It is revealing itself in real time, and the decisions made now may echo for decades.